Something interesting is unfolding. While Western financial institutions quietly stockpile paper derivatives and maintain their comfortable narratives about precious metals being relics of a bygone era, there's a parallel reality playing out across the Pacific that most people aren't seeing. China isn't just buying silver anymore. They're consuming it at a pace that defies traditional market logic. And the price disconnect between East and West has grown so severe that physical silver is now trading at premiums that would have seemed absurd just 5 years ago. The $100 silver phenomenon in China isn't speculation. It's happening right now in real time, documented in premium spreads that tell a story the London Metals Exchange does not want you to examine too closely. We need to start with what's actually occurring on the ground in Chinese markets, because the Western media's coverage of this situation ranges from dismissive to completely absent. Physical silver products in major Chinese cities are selling at premiums that push effective prices near or above 100 per ounce for certain products. Not futures contracts, not paper silver. Actual physical metal that people can hold in their hands. The premiums on coins and small bars have exploded to levels between 40% and 80% above spot price in some regions. And this isn't a temporary spike driven by a collectible craze or numismatic demand. This is industrial scale consumer buying, meeting a supply chain that simply cannot keep pace with demand. Here's where it gets interesting from a market structure perspective. The spot price that everyone quotes, the number you see when you pull up silver on any financial website, is determined primarily by trading activity in London and New York. The COMEX and the LBMA set the global benchmark through futures contracts and vault transactions that are overwhelmingly paper-based. Physical delivery represents a tiny fraction of the total volume traded. We're talking about a market where 500 ounces of paper silver might trade for every single ounce of physical metal that actually changes hands. That ratio creates a price discovery mechanism disconnected from physical supply and demand fundamentals. But China doesn't play by those rules. The Chinese physical market operates with its own dynamics, its own premium structure, its own relationship between supply and demand. When Chinese buyers want silver, they're not satisfied with a warehouse receipt or a futures contract. They want the metal. This cultural preference for physical possession, combined with China's massive industrial demand, creates a market environment that's fundamentally different from Western exchanges. The implication here is striking. We're watching two separate pricing mechanisms diverge in real time, and the gap between them reveals which market is actually backed by physical metal and which one is sustained primarily by leverage and paper promises. Think about what has to happen for premiums to reach these levels in a functioning market. Under normal conditions, when premiums rise in one geographic region, arbitrage opportunities emerge. Traders buy metal where it's cheap, ship it to where it's expensive, and pocket the difference. This process naturally equalizes prices across markets, keeping premiums within a reasonable range that reflects only shipping costs, insurance, and local taxes. The fact that premiums in China have sustained at these elevated levels for months tells you that the normal arbitrage mechanism is breaking down. Either the physical metal isn't available to ship east, or the logistics of moving it can't keep up with demand, or perhaps most tellingly, Western vault holders are becoming increasingly reluctant to part with physical inventory, regardless of the premium being offered. I have watched precious metals markets for long enough to recognize when price action stops making sense through conventional analysis. This is one of those moments. When premiums disconnect from spot prices this dramatically and sustain that disconnect, you're no longer looking at a market in equilibrium. You're looking at a market under stress, where the underlying physical asset is revealing its scarcity while the paper representation continues to trade as if supply is unlimited. Let's examine the supply side, because this is where the story gets genuinely concerning for anyone paying attention. Global silver mine production has been essentially flat for the better part of a decade. We're not discovering massive new deposits. We're not seeing technological breakthroughs that suddenly make low-grade ore economically viable. The existing mines are producing roughly the same amount year after year, with only marginal increases that barely keep pace with reserve depletion. Meanwhile, industrial demand for silver continues expanding, driven by sectors that aren't optional or discretionary. Solar panel manufacturing alone now consumes somewhere between 15% and 20% of annual silver production, and that percentage is growing as renewable energy deployment accelerates globally. Electric vehicles use significantly more silver than traditional combustion engines. 5G infrastructure rollout requires substantial silver for its conductive properties. These aren't speculative uses. This is silver being permanently consumed, removed from the available supply pool, transformed into products that will never return that metal to the refining market. Industrial silver consumption is a one-way street, and China dominates many of the industries consuming it most aggressively. This is significant. When you combine flat mine production with rising industrial consumption, the slack in the market has to come from somewhere. For years, that somewhere has been existing stockpiles, refined silver sitting in vaults, old inventories being drawn down to meet current demand. The question nobody in official positions wants to address honestly is how much longer those inventories can sustain the current consumption rate. The data we do have access to suggests that visible silver inventories, the stocks held in exchange warehouses and reported by major depositories, have been declining, not gradually, but precipitously in some cases. COMEX silver inventories have experienced significant drawdowns. Registered silver, the portion actually available for delivery against futures contracts, has hit levels that should make anyone holding paper silver positions nervous. We're talking about inventory declines of 30%, 40%, sometimes more than 50% in specific categories over just a few years. Now, the bulls defending the paper market will point out that eligible silver still exists in the warehouses, that total inventory numbers look more stable when you include metal that isn't currently designated for delivery. That's technically accurate, but practically meaningless. Eligible silver belongs to someone. It's allocated. The owners have chosen not to make it available for delivery at current prices. If a supply crunch emerges, if delivery demands surge, that eligible silver doesn't automatically become available. Its owners would need to be convinced to sell, presumably at prices significantly higher than current spot levels. This is the moment where we need to confront an uncomfortable reality about how modern commodity markets function. The price discovery mechanism for silver, like gold and many other commodities, isn't primarily driven by people who actually use or possess the physical metal. It's driven by financial institutions trading derivatives, by hedge funds deploying algorithmic strategies, by banks managing complex option structures. These participants don't care about physical silver. They care about price movement, about volatility, about the mathematical relationships between different contracts. Their trading activity dominates volume and therefore dominates price, but it's completely disconnected from the fundamental question of whether actual physical metal exists to back their positions. China's approach represents the opposite philosophy. Chinese buyers, whether individuals, industrial consumers, or state-affiliated entities, are relentlessly focused on physical accumulation. They're not interested in being the counterparty to a naked short position. They want the metal in their possession, in their vaults, in their supply chains. This isn't a trading strategy. It's resource acquisition, and it's being executed with the long-term perspective that characterizes Chinese economic planning. The $100 silver phenomenon is what happens when these two philosophies collide. The Western paper market says silver should trade at $30-something per ounce based on the supply and demand of contracts. The Chinese physical market says silver is worth dramatically more based on the supply and demand of actual metal. Both prices coexist because the markets are semi-isolated, but that isolation is breaking down. Let's take this a step further and consider what the premium structure in China is actually telling us about future price direction globally. Premiums this high aren't sustainable indefinitely. One of three things has to happen. Either premiums collapse because Chinese demand decreases, which seems unlikely given the structural industrial drivers we've discussed, or supply increases dramatically to meet Eastern demand, which is constrained by mine production realities and Western inventory availability. Or, most likely, the spot price adjusts upward until the premium gap narrows to levels where normal arbitrage can function again. That third scenario is what should keep paper silver shorts awake at night. If spot prices need to rise to, say, $70 or $80 per ounce before premiums in China compress back to normal ranges of 10 to 15%, then we're talking about a price more than doubling from current levels. That's not speculation. That's basic market mechanics reasserting themselves after a period of artificial suppression. And yes, I use the word suppression deliberately. I'm not interested in debating whether formal price suppression schemes exist or whether major banks have been found guilty of spoofing and manipulation in precious metals markets. Those are established facts, documented in court cases and regulatory actions. JP Morgan paid nearly $1 billion in fines for precious metals manipulation. That's not conspiracy theory. That's legal settlement history. The question isn't whether manipulation occurs. The question is whether it can continue indefinitely in the face of relentless physical demand. The eastern drain on Western vaults isn't a new phenomenon, but its pace has accelerated dramatically. For years, gold and silver have been flowing from west to east, from the vaults of London and New York to the private holdings and state reserves of Asian nations. This is what you need to know. Physical metal flows in one direction, while paper contracts multiply in another, and eventually these divergent paths reach a point where reconciliation becomes necessary. We saw this pattern play out in gold years ago when Chinese demand exploded and premiums in Shanghai began diverging from London prices. The gold market adjusted. Prices rose globally. The same fundamental dynamic is now playing out in silver, but with more explosive potential. Because silver inventories are smaller, industrial demand is higher relative to available supply, and the paper-to-physical ratio is even more extreme than gold. Consider the logistics involved in draining Western vaults. We're not talking about small volumes. China imports thousands of metric tons of silver annually. Some of this comes from mine production, some from recycling, but a substantial portion comes from existing refined stocks. When a major bank or depository in London or New York ships silver to China, that metal is effectively leaving the Western monetary system. It's moving into hands that have demonstrated a strong preference for long-term holding rather than trading. The physical float available to back Western paper markets shrinks with each shipment east. The Perth Mint situation in Australia offers a revealing case study of what happens when paper promises meet physical delivery demands. For those who didn't follow this closely, the Perth Mint, a government-owned institution, faced allegations that it couldn't deliver on all its allocated metal claims simultaneously. Investors who believed they owned specific physical metal backed by certificates and accounting entries discovered that actually obtaining delivery was becoming difficult, subject to delays, constrained by limitations that shouldn't exist if the metal was truly sitting in allocated storage as claimed. This created a crisis of confidence because it exposed the uncomfortable truth that even supposedly reputable institutions engage in fractional reserve practices with precious metals. They issue claims against metal that exceed the physical inventory they hold, operating on the assumption that not everyone will demand delivery at the same time. That assumption works fine until it doesn't. When confidence cracks and delivery demands surge, the fractional system breaks down rapidly. Now imagine that scenario playing out not at a single mint, but across the entire Western banking system's silver holdings. What happens when Chinese demand, combined with growing Western retail investor demand, combined with industrial consumption, combines to create delivery pressure that exceeds available physical inventory? The paper market doesn't have a mechanism to handle that scenario gracefully. Prices don't adjust smoothly upward. Instead, you get dislocations, delivery failures, force majeure declarations, contract modifications, all the hallmarks of a market breaking under stress. The Chinese understand this dynamic perfectly. Their accumulation strategy isn't about making a quick profit on silver's next price move. It's about securing physical resources while they're still available at prices that, from a long-term perspective, are absurdly cheap. When you're planning decades ahead, when you're thinking about your nation's industrial capacity and resource security in 2040 or 2050, paying $100 per ounce for silver today looks like a brilliant decision if that metal becomes unavailable at any price in 10 years, because global supply has been consumed by structural industrial demand. The solar build-out alone provides a compelling case for why silver could become genuinely scarce. China has committed to massive renewable energy expansion. So has Europe. The United States is behind, but moving in the same direction. Each gigawatt of solar capacity installed requires substantial silver for its photovoltaic cells. As manufacturing efficiency improves, the silver content per panel decreases slightly, but total panel deployment is increasing so rapidly that total silver consumption continues rising. Industry analysts project solar could consume 15 to 20% of annual silver production within a few years. Some estimates run even higher. Electric vehicle adoption creates another structural demand driver. The average EV contains roughly twice as much silver as a comparable combustion engine vehicle. Multiply that by tens of millions of vehicles as the global fleet electrifies, and you're talking about thousands of additional tons of silver demand that didn't exist a decade ago. Then you have 5G infrastructure, medical applications, water purification systems, and dozens of other industrial uses where silver's unique properties make it difficult or impossible to substitute with cheaper alternatives. This isn't jewelry demand that can contract when prices rise. This is industrial demand that persists regardless of price because the products being manufactured require silver as specific characteristics. And let's bring this together. We have flat mine production, rising industrial consumption, declining visible inventories, massive Eastern physical demand, and paper markets that continue trading as if none of these factors matter. That disconnect creates opportunity for those positioned correctly and catastrophic risk for those on the wrong side. The $100 silver in China is a signal. It's the market telling anyone willing to listen that physical metal is significantly more valuable than the paper price suggests. It's a preview of where global prices eventually need to go to balance supply and demand. It's evidence that the arbitrage mechanisms that normally keep prices aligned across markets are failing, which means the underlying physical scarcity is real and intensifying. For Western investors, this creates a specific strategic consideration. If you hold paper silver in the form of ETFs or futures contracts, you're exposed to counterparty risk that most people don't fully understand. When a supply crunch materializes, when physical delivery becomes problematic, these paper instruments don't necessarily converge to the physical price. Instead, they can be settled in cash, often at prices determined by the very institutions that issued them. You might own a claim on silver, but that's fundamentally different from owning actual silver. The Chinese buyers paying $100 premiums understand this distinction viscerally. They're not interested in owning a number on a screen that represents silver. They want the metal in their physical possession specifically because they understand that ownership and possession are not the same thing in modern financial markets. Watch what the smart money is doing, not what it's saying. Central banks globally have been net buyers of gold for years, repatriating reserves, building stockpiles. Meanwhile, their public statements consistently downplay precious metals as outdated relics. The contradiction should tell you everything you need to know about the gap between official narratives and actual accumulation strategies. China has been particularly aggressive in this regard, building gold reserves while simultaneously developing alternative systems to bypass dollar-denominated commodity trading. The Shanghai Gold Exchange, the various commodity pricing mechanisms being developed within BRICS frameworks, these aren't random initiatives. Maintain, the $100 silver in China is an early indicator of that transition already beginning. The Western financial establishment will dismiss this analysis as alarmist or conspiratorial until the moment when physical shortages become undeniable. That's been their pattern with every previous market dislocation. They maintained that subprime mortgages were contained until the entire financial system nearly collapsed. They insisted inflation was transitory until it became entrenched. They'll maintain that silver markets are functioning normally until delivery failures make that position untenable, but you don't have to wait for official acknowledgement to position yourself accordingly. The evidence is visible right now for anyone willing to examine it honestly. Physical premiums in Eastern markets are telling you that real silver is more valuable than paper silver. Inventory drawdowns are telling you that available supply is contracting. Industrial demand trends are telling you that consumption is growing. Mine production data is telling you that new supply isn't coming online to meet demand. The arithmetic isn't complicated. When consumption exceeds production year after year, stockpiles decline. When stockpiles decline far enough, prices have to rise to ration available supply. We're watching that process unfold in real time, hidden beneath the surface volatility of paper markets that mask the underlying physical reality. The Chinese aren't paying $100 premiums because they're irrational or uninformed. They're paying those premiums because they've done the same analysis and reached the conclusion that securing physical silver now, even at prices that seem excessive relative to spot, is preferable to potentially being unable to acquire it at any price later. That's the perspective of serious resource planners, not speculators looking for a quick trade. For anyone holding significant wealth, the question isn't whether to own some physical precious metals. The question is whether your current allocation adequately reflects the probability that paper currencies continue depreciating, while physical resources appreciate. The answer for most people is probably no, which is why demand for physical metals continues growing even as the mainstream financial media treats precious metals as fringe investments. The vault drain from west to east will continue until either Eastern demand is satisfied or Western supply is exhausted. Given China's strategic objectives and resource requirements, their demand isn't getting satisfied anytime soon. Given inventory trends and production constraints, Western supply is depleting steadily. The $100 silver phenomenon in China is what happens when unstoppable demand meets increasingly immovable supply. It's a preview of the price adjustment that eventually comes to global markets, when reality can no longer be postponed by paper derivatives and accounting gimmicks. Pay attention to what is actually happening in physical markets rather than what financial institutions tell you should be happening. The metal is moving east, the vaults are draining, the premiums are exploding. These are facts, not theories. How you respond to those facts determines whether you're positioned for the transition ahead or caught exposed when the paper markets finally reconcile with physical reality. The story of $100 silver in China is ultimately the story of two different monetary systems diverging, one backed by physical resources and one backed by debt and digital entries. We are watching in real time which system serious economic powers choose to trust with their long-term wealth and industrial capacity. That choice should inform your own decisions about where and how to preserve purchasing power as the global financial architecture continues its slow-motion transformation. They're part of a coherent strategy to establish pricing power over physical resources independent of Western paper markets. Silver fits into this broader pattern, as the dollar's global reserve status gradually erodes, as alternative trading systems develop, as physical resource scarcity becomes more apparent. The disconnect between paper prices and physical values will become impossible to